Imagine an entire category of organizations that, just by their very nature, are exempt from federal income tax.
Sounds like, well, an incredibly powerful financial advantage, right?
It absolutely is a huge advantage.
Yeah.
But here's the catch, maybe.
Yeah, where it gets really interesting, this massive fiscal benefit. It comes hand in hand with an incredibly complex rule book. Not exactly simple.
Definitely not simple. Very detailed.
So today, we're going to take a deep dive into this fascinating world. Tax-exempt organizations, specifically the ones you probably hear about most, the 501c3s.
That's right. Charities, foundations, educational institutions, religious groups, that whole category.
Our mission really is to pull out the most important nuggets of knowledge from the sources you've given us. We want to help you understand the surprisingly strict requirements they have to meet.
Both to get that status and maybe even more importantly, to keep it.
Exactly. Because understanding these rules isn't just about, ticking boxes for compliance. It's about safeguarding those huge financial benefits.
Optimizing the organization's finances, really. And avoiding some incredibly costly pitfalls that could, honestly, put their whole mission at risk.
It really could.
So think of this as a shortcut, a way to get well-informed on a topic with some really significant financial implications.
Definitely significant. Okay, where should we start?
Okay, let's unpack this foundational idea first. When we talk about a tax-exempt organization, what are we actually defining here? What makes them stand out so much financially?
Well, at its core, it's a not-for-profit entity. Simple enough, right? But the key is it qualifies for exemption from federal income tax.
Qualify. So there's a process, specific rules.
Exactly. And while the IRS code actually lists several different types, Section 501c3 is, by far the most common one, the one people generally mean when they say nonprofit.
Public charities, private foundations.
Right. Religious orgs, schools, all those, they really form the bedrock of so much public service work.
And their prevalence just shows how important they are. But the rules governing them, that's what allows them to put more money towards their mission instead of taxes.
Precisely. It's like a carefully crafted framework. The whole idea is to encourage and enable public good by offering this significant financial advantage.
So it's definitely more than just slapping a not-for-profit label on something. It's a specific legal status. Needs very particular criteria.
Very particular.
Our sources lay out what they call 4 foundational pillars for qualifying as a 501c3. And these aren't like suggestions, are they?
Oh, no, absolutely not. They are hard requirements. All must be met to get and keep that incredibly valuable tax status and the tax saving that comes with it.
Okay, so where does the journey start? What's the absolute first pillar an organization needs to get right?
The first one, non-negotiable, is all about the organization's structure, how it's legally set up.
Structure.
To qualify as a 501c3, it must be formally structured as a corporation.
Like a regular corporation?
Well, yes, or an LLC that's a limited liability company, but only if it chooses to be treated as a corporation for tax purposes. That's an important distinction.
Got it. LLC treated as a corporation. What else?
Or it could be an unincorporated association. Or, finally, a trust.
And this isn't just paperwork. It's fundamental.
Oh, absolutely fundamental. It establishes a legally recognized entity, separate from the founders, separate from the members. It gives it a legal identity.
So it can own things, make contracts.
Exactly. And, crucially, it can exist independently of the people who started it. Provides that legal container.
I'm curious about the unincorporated association. That sounds, well, a bit less formal than a corporation or a trust. Can you dig into that a bit? What does that actually mean?
Yeah, that's a great question. It does sound less formal, and in some ways it is. An unincorporated association is basically a group, 2 or more people who've just joined together by mutual consent for a common lawful purpose.
It doesn't have to be nonprofit.
Technically, no, they can exist for profit, but for 501c3 purposes, obviously, we're talking about ones pursuing a not-for-profit goal.
Okay.
The sources give a good example. Think about a group of neighbors. They decide to work together, pool resources, maybe raise funds to keep the local library open.
Yeah.
They might have some bylaws, maybe elected leaders, a separate bank account, sure, but they haven't gone through that formal state incorporation process.
Okay, so what's the practical difference then if a group chooses that path? Especially thinking about finances and risk.
The difference is pretty significant there. While it's simpler, maybe cheaper to start an unincorporated association.
Less paperwork, I assume.
Right. But the big trade-off is usually liability protection. It generally offers its members less personal liability protection than a corporation,
Meaning?
meaning the members, the individuals in that group, could potentially be held personally liable for the organization's debts or legal issues.
Ouch. Okay, that's a big deal.
It is. For many groups, especially if they grow, take on bigger projects, or face potential risks, that limited liability shield you get with a corporation becomes really, really important, often decisive.
So it's a critical early decision. Impacts the financial security of the organization and the people involved.
Exactly. It's a key strategic choice right at the start.
Makes sense. So even with that less formal option, there's still a clear purpose, a structure. And I see a critical point here about what doesn't qualify. This seems vital.
Absolutely vital. The IRS is crystal clear on this. Sole proprietorships.
Just one person running something.
Right. Or partnerships, or just individuals acting alone, they simply do not qualify for 501c status,
Yeah.
period.
So choosing the wrong structure right out of the gate.
Kills the whole thing before it starts, basically. You completely negate any chance of getting those federal income tax benefits. It's foundational. Directly impacts the ability to operate tax-free, attract deductible donations.
Trying to build on sand, like you said. Okay, pillar 1, structure. Nailed it. What's next? The sources call it the exempt purpose. Sounds like the heart and soul.
It really is. Pillar 2, the exempt purpose. A 501c3 has to be organized and operated exclusively for one or more specific exempt purposes.
Exclusively. That word seems key.
Incredibly important. It means the organization's main focus, its resources, its activities, they all have to line up directly with these defined public benefits. It's not just a nice mission statement on the wall.
It's the legal justification for the tax break.
Exactly. It's the core reason society grants that significant tax exemption and allows tax-deductible contributions. If you don't have a legit, consistently pursued exempt purpose, the whole basis for tax exemption just crumbles.
And with it, the ability to save that money from taxes.
Right.
So what are those specific purposes? The list in our sources looks pretty broad, covering a lot of ground.
It is pretty comprehensive, yeah. And quite specific. The sources list them out. Charitable.
Which is itself a big category, right? Helping the poor, advancing education.
Exactly. Relief of the poor, distressed, underprivileged, advancing religion or education, maintaining public buildings, things like that. Then obviously religious purposes, churches, synagogues, mosques. Scientific purposes, think research in the public interest. Testing for public safety organizations, testing consumer products, literary purposes, educational purposes, schools, universities, public education groups.
What else? There were a couple more specific ones.
Right. Fostering national or international amateur sports competition. But, and this is a really important but.
Uh-oh. Caveat time.
Yes. Only if none of its activities involve providing athletic facilities or equipment. So it's about promoting the competition itself, not running the gym or stadium.
Interesting distinction.
Okay.
And the last one. The prevention of cruelty to children or animals.
That's quite a list.
Yeah.
Diverse, but like you said, you can see the common thread. Public benefit, something society wants to encourage.
Exactly. The specific nature of these purposes really highlights that societal benefit. It's not just doing good generally. It's doing good in these specific, recognized ways that serve the public interest. That's what warrants the tax advantage.
So for an organization, defining and sticking to one of these is step 1 for eligibility.
Absolutely. Deviating puts the whole status at risk. Okay, right structure, clear exempt purpose. Pillar 3 feels like it's about keeping things clean. No private benefit allowed. Sounds like a strong barrier against abuse.
It's an absolute prohibition, and the IRS enforces it rigorously. A 501c3 must not be organized or operated for the benefit of private interests, period.
Private interests meaning?
Meaning no part of the organization's net earnings can benefit any person who has a personal, private interest in its activities. Think of it like this. The organization exists for the public, for its mission, not for specific individuals.
Especially not the ones in charge or close to it.
Exactly. Violating this isn't just about taxes, it destroys public trust, donor confidence. You can't easily get that back.
What kinds of private interests are we talking about? The sources mention the creator's family, shareholders, obvious ones, but it must go deeper.
Oh, much deeper. And this is where things can get pretty nuanced. Those examples are clear-cut, sure, but it really extends to anyone who could potentially exert control or stands to gain financially in a way that's not related to the mission.
Like board members, key staff.
Could be. Founders, board members, key employees, even major donors potentially, if their private interests are served disproportionately.
For example,
Well, say an organization pays its CEO a salary that's way, way above market rates for similar jobs in similar organizations, that could be flagged as private benefit.
okay.
Or if it makes deals, say, contracts with businesses owned by board members, but those deals are maybe too favorable and there wasn't a proper bidding process or due diligence, that's another red flag.
Right. Looks like self-dealing.
Essentially,
Mm.
the rule is designed to ensure that the people running or close to the organization can't personally profit from its tax-exempt status or earnings in a way that undermines the public
It's
purpose.
fundamental to keeping that tax-exempt integrity.
Absolutely. If the activities mainly benefit private individuals, not the public, it directly jeopardizes that tax-saving status. Public benefit has to clearly outweigh private gain.
Prevents it from becoming a loophole for getting rich.
Exactly, and this is where good governance, transparency, they become crucial strategic tools for protecting the organization's financial health.
Makes perfect sense. Maintain the charity of purpose. Keep the public good front and center. Which leads us nicely to Pillar 4, which touches on some sensitive areas. Strict restrictions on political and legislative activities. A critical boundary, it seems.
Incredibly important, yes, and an area where organizations have to be extremely careful. Overstepping here is a direct threat to their tax-exempt status and therefore their tax savings.
The IRS doesn't want these tax-advantaged groups becoming political tools.
Precisely. Let's break it down. Two main categories. Political activities, meaning campaign intervention, and legislative activities, which is basically lobbying.
Okay, let's start with the political side. Campaign intervention. I'm guessing that's a pretty hard no.
An absolute no, a complete prohibition. 501c3s are strictly forbidden from directly or indirectly participating in or intervening in any political campaign for or against any candidate for elective public office.
Any campaign, any candidate, direct or indirect. Wow.
It's broad. It's not just writing a check or making an endorsement, though it includes those. It also covers things like public statements of position made on behalf of the organization for or against a specific candidate.
A very bright line then.
Extremely bright. The IRS sees it as a direct violation of the nonpartisan nature required for tax exemption.
So they can't use their resources, even subtly, to back a candidate. But what about things like, say, voter education or registration drives? That seems like it could get tricky fast.
It does get tricky, and that's where organizations need to be very precise, very strategic. Direct intervention is out. But certain voter education or registration activities are not prohibited. If. Big if. If they are conducted in a completely unbiased, nonpartisan manner.
So.
Well, providing purely factual information on how and where to register to vote, generally fine.
Yeah.
Hosting a debate where all legally qualified candidates are invited and get equal time, generally fine.
But the key is neutrality.
Absolute neutrality. If the information seems skewed to favor one side, if a registration drive only targets folks known to vote a certain way, if voter guides look biased, that crosses the line.
So documenting that nonpartisan approach is key.
Meticulously. It's vital for groups wanting to inform the public, encourage civic engagement, without endorsing anyone. It preserves their ability to avoid tax trouble and serve their mission. It's a strategic tightrope walk.
Inform, don't influence. Got it.
Yeah.
Now, what about the other side? Legislative activities. Lobbying, another area where groups might want to advocate, but the rules clamp down.
They absolutely do. And again, careful planning is essential here. An organization does not qualify for 501c status if a substantial part of its activities is attempting to influence legislation. Lobbying.
Substantial part. There's that word again.
Right. And legislation here means specific things. Actions by Congress, state legislatures, local councils, actual laws, bills, resolutions.
That doesn't include.
Importantly, it generally doesn't include actions by executive, judicial, or administrative bodies. So, for instance, commenting on proposed regulations from an agency. That's usually administrative advocacy, not legislative lobbying under this rule.
Okay, so it's about influencing lawmakers directly on specific bills. What counts as attempting to influence legislation? And how on earth does an organization know if it's crossed that substantial part line? It's clear.
Attempting to influence is defined pretty broadly. It includes contacting lawmakers directly or urging the public to contact them to propose, support, or oppose specific legislation, advocating for or against bills.
Direct lobbying and grassroots lobbying.
Exactly. Now, that substantial part rule, Historically, it was kind of vague, a facts and circumstances test, which isn't very helpful for planning.
Sounds risky.
It could be, but for public charities, there's actually a specific option, an election under Section 501 of the tax code.
501, what does that do?
It allows public charities to quantify their lobbying limits. It uses a sliding scale based on their annual spending. It provides a clear, numerical, safe harbor.
Uh-huh. So predictable financial boundaries for lobbying.
Exactly. It's a crucial strategic tool. If they make that 501 at election and stay within those defined spending limits for lobbying, they generally won't lose their tax-exempt status over it.
And if they don't make the election,
Then they're stuck with that vaguer, a substantial part test. Much more room for interpretation, much more risk.
so making the 501 election seems like a smart move for any charity planning significant advocacy.
For many, yes, it avoids ambiguity. These restrictions, overall, they stop organizations becoming political arms, reinforce that public service role. Overstepping, especially without the 501X safety net, is a direct threat to their tax status, their ability to save money for the mission. It's a fine line, needs careful strategic navigation.
Okay, so we've laid out these 4 huge pillars needed just to qualify. Structure, purpose, no private benefit, and limits on political lobbying work. But getting the status is only half the story, right?
Absolutely. Maintaining it is an ongoing job.
Our sources really emphasize the peril of losing this status. It's not theoretical, it happens. What are the consequences if an organization slips up after it's established?
Losing tax-exempt status is, well, it's severe, catastrophic, really, for a nonprofit. It means suddenly, boom, you're subject to federal income tax, just like a regular business.
Which mean?
A huge jump in operational costs, a big chunk of revenue, maybe from donations or programs that used to go straight to the mission, now gets diverted to taxes.
Undermines their whole financial model?
Completely. It can jeopardize their ability to even operate, fulfill their mission. And it makes fundraising much harder, too, because donations are no longer tax-deductible for the donor. It's a massive blow.
Not just a slap on the wrist, then. It's fundamental. So what are the key things, the activities or failures that actually trigger this loss? Are there common tripwires?
There are several critical ones organizations need to watch out for constantly. First, engaging in activities not related to the stated tax-exempt purpose.
Straying from the mission.
Exactly. Now, there's a little leeway. If these unrelated activities are an insubstantial part of the total activities, maybe okay. But if they become significant, it shows the organization isn't focused.
Like your historical society example, 10% restoring buildings is okay, but 40% speculating on unrelated real estate. Problem.
Precisely. It highlights why staying true to your mission statement, making sure your activities align, is so critical financially.
So a charity starting a side hustle, manufacturing widgets for profit, probably in trouble unless it's tiny and truly insignificant.
Right. Or, even worse, if the organization starts operating for the primary purpose of running a trade or business, not related to its exempt purpose.
How's that different from just having some unrelated activities?
This is different from unrelated business income, or UBI, which we'll get to. With UBI, just some income gets taxed, but the organization stays exempt overall. Here, we're talking about the entire organization's primary purpose shifting to become commercial, not charitable.
Like a hospital becoming mostly a luxury spa.
That kind of fundamental shift, yes. That directly challenges the whole basis for being exempt in the first place.
And I bet that no private benefit rule comes back here too. It's not just for getting status, but keeping it.
Absolutely. Any activity, any earnings benefiting private interests, that's a direct violation, an ongoing requirement, such a core principle.
Because it undermines the public trust aspect.
Exactly. Diverting funds or activities for personal gain, excessive salaries, sweetheart deals, disproportionate benefits to insiders. It just destroys the foundation. The IRS takes it very seriously.
What about the political and lobbying rules? Violating those can also lead to revocation.
Definitely. Direct participation in political campaigns, that absolute red line we talked about. Cross it, and revocation is likely swift.
No messing around there.
No. And substantial lobbying, especially without that 501 election cushion, also grounds for revocation or maybe significant financial penalties called excise taxes.
Penalties on the organization or maybe even the managers.
Or both, yeah, depending on how bad it is. So again, that substantial threshold for lobbying and unrelated activities is something they need to constantly monitor. It's a continuous balancing act.
So it's about what you do, but also what you don't do. Any administrative mistakes that can cause loss of status. Even if the mission stuff is perfect, diligence seems key.
This is a huge one, often overlooked. tragically common, simply failing to meet annual filing requirements, like filing the Form 990 return.
The informational return.
Right. It provides transparency to the IRS and the public. If an organization fails to file that Form 990 for 3 consecutive years,
3 years.
3 years, their tax-exempt status is automatically revoked. No audit needed, just gone.
Wow. Just for not filing paperwork.
It highlights that keeping this valuable financial status isn't just about the mission. It requires meticulous admin compliance. Simple oversight can kill your status. Many have lost it this way.
That's a critical warning. It really sounds like all these rules are connected. Maintaining tax-exempt status is this continuous, complex effort. Strategic planning, rigorous admin discipline.
It really is. For anyone involved, or even thinking about forming one, understanding these pitfalls is absolutely paramount. It's about protecting the organization's financial health so it can actually do its mission without surprise tax bills.
Proactive understanding, consistent application. That's the real strategy for preserving resources.
That's the core of it. Yeah.
Okay, so we've covered getting status, losing status. But what about the middle ground?
Yeah.
Situations where a perfectly qualified tax-exempt organization still pays tax on some income. This brings us to UBI, unrelated business income.
Right. UBI. This is a really vital concept and, honestly, often misunderstood.
How so?
Because, yes, even a fully qualified, legitimate 501c3 can end up paying regular corporate income tax on certain earnings.
When does that happen?
It happens when it earns income from a business activity, a trade or business that is not substantially related to its tax-exempt purpose. That's UBI.
So it's about specific income streams, not the whole organization.
Exactly. It's not about losing your exempt status overall. It's about preventing that status from being, let's say, unfairly leveraged to run a commercial business tax-free when that business doesn't actually further the mission.
Okay. Keeps things fair with for-profit businesses too, maybe.
That's part of the thinking, yes. So understanding how UBI works, how to navigate it, is crucial for optimizing the organization's overall financial health. You don't want surprises.
So how is UBI specifically defined? What are the tests? What makes income unrelated business income?
Okay, there are 3 specific criteria, and all 3 must be met for income to be UBI.
All 3. Got it.
First, the income has to come from an activity that is a trade or business, meaning, selling goods or services for profit, operating like a regular commercial venture.
Okay, trade or business, number 2.
Second, that trade or business must be regularly carried on. This isn't about a one-off fundraiser. It implies frequency, continuity, acting like similar for-profit businesses operate.
Year-round, regular hours, that kind of thing.
Potentially, yes. And third, and this is often the key, the activity must not be substantially related to the organization's tax-exempt purpose.
Let's dig into those last 2. Regularly carried on. What's the line between a one-time event and something ongoing?
Good question. Regularly carried on implies consistency. Think about, say, an annual charity gala dinner. Huge fundraiser, sure. But it happens once a year, generally not considered regularly carried on.
Okay.
But contrast that with maybe a museum gift shop. If it's open year-round, regular hours, selling mostly stuff unrelated to the exhibits like generic toys or souvenirs, that looks a lot more like regularly carried on. The comparison is often to how for-profit businesses operate.
Makes sense. And not substantially related. That sounds like the really tricky one.
It often is the trickiest, yeah. The core question is, does the business activity itself contribute importantly to achieving the organization's exempt purpose, other than just providing money?
So, the hospital cafeteria example again. Serving patients and staff.
That's substantially related. Contributes to patient care, efficient operations. But if the hospital opens a big commercial parking garage, mainly for the general public, making money, probably not substantially related to patient care itself, even if the profits help the hospital.
Okay. Or the university summer camp.
Right. If it's mainly for their own students, probably related. If it's marketed widely to the general public, purely recreational, might cross the line into unrelated business. The activity itself needs to contribute to the mission.
Those examples really help clarify. So running that public parking garage or the general summer camp could mean paying tax on that income, even for a tax-exempt hospital or university.
Potentially, yes. That income could be subject to UBI tax.
But our sources also list key exclusions from unrelated trade or business activities. Now, this sounds like where the strategic financial planning comes in. Activities that look like business but aren't UBI if they meet certain conditions.
Exactly. These are specific carve-outs. Knowing them allows organizations to structure revenue-generating activities to avoid UBI tax liability. It's a direct path to optimizing financial health.
Okay, give us some examples. What's excluded?
Well, one classic example is income from bingo games. But there are conditions.
Always conditions.
Right. It has to be legal where it's played and generally restricted to nonprofits running them in that state or locality. It's a nod to traditional fundraising.
So the Friday night charity bingo is usually safe? Good to know. What else?
A big one. Any activity conducted mainly for the convenience of the organization's members, students, patients, or employees.
Ah, like the hospital cafeteria again, or a university bookstore, primarily for students and faculty.
Precisely. Even though they're selling things, the primary purpose is seen as supporting the main exempt function, patient care education. So that income is typically excluded from UBI. It directly supports the mission's operations.
Okay, convenience is key there. What else is carved out?
Income from convention or trade show activity. This acknowledges that professional groups, educational institutions often hold these as part of their mission. So exhibitor fees, attendee fees, generally not UBI.
Makes sense for associations.
Also, the exchange or rental of membership lists between certain tax-exempt organizations, generally excluded, and a really important one, the sale of merchandise received as gifts or contributions.
Like a thrift shop, selling donated clothes, furniture.
Exactly. Think Goodwill, Salvation Army stores.
Yeah.
The income from selling those donated items is typically not UBI because the merchandise was given to them charitably, not bought for resale like a regular store.
That's a massive financial advantage for them. Allows them to turn donated goods directly into program funding.
Huge. It's fundamental to their model. Also excluded is income from the sale of articles made by disabled persons as part of their rehabilitation. This supports vocational training, seen as furthering an exempt purpose.
Okay.
And finally, a very broad and important one. Any activity where substantially all the work is performed by unpaid volunteer workers.
Wow, that covers a lot of classic fundraising. Bake sales, car washes.
If pretty much everyone doing the work is a volunteer, the IRS generally views that activity as non-commercial in nature, so the income isn't UBI. It really encourages volunteerism.
That last one feels like a real aha moment. Knowing these exclusions isn't just about avoiding tax hits, it's a direct strategic pathway. Design your earned income activities around these rules to keep that tax advantage.
Absolutely. It's proactive financial management. And beyond these excluded activities, there are also certain types of income that are generally excluded from UBI, pretty much regardless of the source.
Well, passive income, maybe.
Mostly, yes. This is vital for managing endowments, investments efficiently. Maximizes the organization's financial stability. These are income streams the IRS generally doesn't see as active business income.
Okay, what types are we talking about? Because for groups with investments, this could be huge for long-term health.
It is. It's a cornerstone of endowment management. Generally, dividends, interest, annuities, and other typical investment income are excluded from UBI.
So endowment returns can grow tax-free.
Largely, yes. That's how universities and foundations build those large funds over time. Also, royalties are typically excluded.
Royalties like?
Income from licensing, say a name, a patent, a copyright, maybe a mailing list rental if structured as a royalty. As long as the organization isn't super actively involved in generating that income, just collecting payment for use of the asset.
Another big benefit. Allows leveraging assets without immediate tax. What about real estate? Lots of nonprofits own property.
Good question. Rents from real property are generally excluded from UBI. Great for organizations renting out space, but
The caveats again.
always caveats with rent. If the organization provides significant personal services to the tenant along with the space, the income might become UBI.
What kind of services?
Beyond basic utilities and maintenance. Think extensive cleaning, catering, event planning, staffing provided with the rental, like for that church fellowship hall example. If it looks more like running a hotel or event venue than just renting space, the IRS might say it's taxable service income, not passive rent.
So just renting the space is fine, but adding lots of active services changes the game.
It can. Another caveat, if the lease includes both real property and personal property like furniture, equipment, and the rent value tied to the personal property is significant.
Like more than half the total rent.
If it's more than 50%, the entire rent, including the real property part, could become UBI. If it's between 10% and 50%, just the personal property part might be UBI. So you have to structure leases carefully. It's not just rents is fine, it's how you rent.
Wow. Subtle but crucial for avoiding unexpected taxes. Any other big income exclusions?
Yes. Income from research done by a college, university, or hospital is typically excluded, recognizes the public benefit, core part of their mission.
Makes sense.
And finally, gains and losses from selling property, but only property that wasn't held primarily for sale to customers in the ordinary course of business. Meaning selling investment assets. Like if an organization sells stock from its endowment or sells a piece of land it was holding for future use but didn't need, that capital gain generally isn't UBI.
But if they were, say, buying and flipping houses as a business.
That would likely be different. That looks like selling inventory in the ordinary course of business. So
Yeah.
selling off occasional investment assets, usually fine tax-wise. It's powerful for managing portfolios long-term.
Absolutely. Allows strategic asset management. Understanding all these UBI exclusions, activities, and income types lets organizations really manage their revenue streams smartly, keep more money for the mission.
It's all about that proactive financial management within the rules, optimizing their capacity for public good.
Brilliant breakdown of UBI. Shows the complexity, but also the strategic benefits available. Now, just before we wrap, our sources mention one more area: special considerations for membership organizations. Suggests more layers, right? Not one size fits all.
Indeed. We've focused heavily on 501c3s, charities, educational, religious groups, but it's important to remember there are other types of tax-exempt orgs.
Like social clubs, homeowners associations.
Exactly. Social clubs are often 501c7. Homeowners associations might be 501c4. They operate under different rules in the tax code, reflecting their different purposes.
So still tax exempt, but their income rules aren't identical to a charity's. What's the main difference?
That's right. For many of these membership organizations, the general rule is actually kind of the opposite of a C3. They're usually taxed on all their gross income,
All of it.
and less deductions directly tied to producing that income, unless the income qualifies as exempt function income. That's their key financial advantage, their main carve-out.
Exempt function income. Okay, what does that cover for them?
It's pretty specific. It's defined as gross income from dues, fees, charges, or similar payments from members for the goods, facilities, or services the organization provides to those members, their families, and guests.
So money paid by members for member benefits.
Exactly. That specific income directly related to serving their membership base is not taxed. For a social club, think annual dues for using the clubhouse, greens fees paid by members, charges for member-only parties. That's exempt function income.
But what about income from non-members?
That's likely different. If the social club rents its ballroom out to the general public for a big wedding or sells merchandise widely to non-members, that income probably is taxable, potentially as UBI for them. The distinction reinforces their primary purpose: serve the members.
That really illustrates the point. Taxating principles, the rules for preserving financial resources, they vary even within the nonprofit world.
Yeah.
You absolutely need specific understanding for your exact type of organization.
Precisely. Can't just assume the 501c rules apply to everyone. Each category has its own nuances. Knowing your specific section of the tax code inside and out is key to compliance and optimizing finances.
What a deep dive this turned out to be. We really covered a lot of ground. The detailed requirements for tax-exempt organizations, from structure and purpose, right through to the activities and income types that can save them or sink them tax-wise.
Yeah, it's a complex landscape.
And what seems absolutely clear is that the main tax-saving method for these groups isn't about finding clever loopholes. It's about careful, meticulous adherence to this whole set of rules. Rules designed to make sure they primarily serve a public benefit.
That's the heart of it. Strategic financial management for nonprofits is just deeply, fundamentally intertwined with sticking to their mission and following these regulations.
Every rule we talked about, structure, no private benefit, the political limits, it all reinforces that public service mandate. Ensures these powerful financial advantages are used the way they're intended.
And understanding these rules isn't just defense, avoiding penalties. It's offense, too. It empowers organizations to maximize their impact, keep more resources focused where they matter most, by minimizing that tax burden legally.
So as we've seen, it's far from simple.
Mhm.
Requires really careful navigation to keep that invaluable status and the financial benefits.
Mm.
Which does raise an interesting question looking forward.
Mm-hmm.
How might the increasing complexity, maybe the increasing scrutiny of these regulations influence new nonprofits? The ones just starting up in the years to come.
That's a fascinating thought.
Will it push them towards more specialized structures?
Yeah.
Or maybe drive totally new, innovative models for delivering public service, models designed from day one to rigorously fit these intricate rules?
Could definitely shape how people approach setting up organizations, yeah. Interesting times ahead.
Something to think about. We'll leave that final thought with you.